Well, hello, and a very warm welcome to you today. I'm Alec Hogg, coming to you from BizNews, and we got some, I always say it when with our business partners from OrbVest, but some exciting news for you. Maybe we can hand over in just a moment, but let me introduce the guys in case you haven't yet met them. Martin Freeman is the Chief Executive of OrbVest. Martin, where are you based today?
I'm still in Westchester, New York. You can see it's sunrise behind me.
Fabulous. Just the sun just coming up in the morning, and as we know, Justin Clarke, who's here with also in South Africa, every time we have Martin on these webinars, Justin, he has to make a pretty early rise.
Yeah, Alec, certainly it's good to get him up early. You know, it makes it a nice long day. Yeah, I think you know, a lot of our team are moving overseas to join Martin, so I'm going to be one of the few left standing here, obviously, apart from our our support staff, which are based in Cape Town. So yes, good to be here again today.
Are you based in Durban?
That's correct, Alec. Right near the activity of the end of July, in the Bellito area of KZN.
Incredible. Well, what you guys went through was kind of off the charts, and I think there are quite a few people who are joining us today who's saying, "Whoa, hang on a minute! You know, that was one step just too far." If it did one thing, and all our reporting after the anarchy of the past month, all the experts were saying to us, "Please just diversify, get yourself, protect yourself by investing abroad." Martin, I don't know how much of the South African anarchy was being reflected in the US, because I know the US kind of likes to talk about America. But did you get much coverage of it there in the major news channels?
So from my side, Alec, what actually happened was I was supposed to be in South Africa, as you know, and I had to postpone my trip because of the COVID wave and the lockdown. So when I was in Europe, it exploded all over my WhatsApp channels and over every single possible person that I'd spoken to. More importantly, the question you ask is, was there exposure? Yes, there was. In fact, the BBC, it was headline news around the world constantly for 3 days. So it certainly left a huge scar on South Africa's reputation. And when I got back, people were pretty perturbed and asking me what had happened in South Africa. And we're just very thankful that things seem to have quietened down.
Well, certainly from the province that I hail from and where Justin lives in KwaZulu-Natal, we have obviously many friends and lots of family there. For them to be spending nights having to patrol their homes or the suburbs of their homes, do their little bit, make the ladies making food for the men who are out there patrolling. I mean, this is like wartime stuff. This is not like normality. And what I did notice, and I'd be very interested to hear from you, Justin, when talking to Magnus Haystack this past week, he said he was down at Val de Vie, where he has a flat, and he said the hotel at Val de Vie, the Pearl Valley Hotel, is usually empty at this time of the year because it's winter. He says it's chock-a-block. You can't get in there at the moment, all with people having a look at how they can relocate out of hotspot areas. Are you seeing something similar in the province?
So I stay in a gated estate as well, one of the big ones on the north coast, and we were incredibly organized over the course of the incident, and the agents well, certainly shared with us that they'd had a huge spike in people looking for temporary rental accommodation within the estate. So I think that backs it up, Alec. I think there's definitely going to be a drive towards areas that are slightly more secure, and I think that's an indication for those property buyers that still have the courage to invest locally.
Alec, let's not forget also that there's 3 Durbanites all online today. As a ex-Westville boy myself, and with all my family and friends in KZN, it was even more heartened. And yeah, I think that what we've experienced as OrbVest is an enormous spike in terms of people saying, look, how do I get my money offshore, or at least a part of it? How do I diversify? And certainly, people were and are still pretty rattled by it. But I think that as much as we might look at the negative, we do need to look at the upside and say that we're very thankful that it did quieten down very quickly, and hopefully that South Africa learns from it.
Indeed. Well, we're going to be talking now about yet another opportunity. How many is this? What number project is this, Martin?
So this is number 34, and in fact, we're going to be covering 2 new projects today. It's the launch of 34, and it's the launch of another very exciting thing we're going to talk about later called the triple net portfolio. So what we'll do is initially we're going to kick over to Justin, who'll cover Medical 34, our Cincinnati launch. And again, it's just another good, solid investment with good, stable tenants where you can move your money offshore and know that you can sleep well at night, knowing that your dividends will flow in hopefully every quarter.
Smashing. Well, before we get into that, let's first of all find out that all the tech is working well. If you can hear us okay, if we're coming through to you loud and clear, there's a little high five barrier, icon on the control panel. Please just click that to let us know. Thank you very much. It's coming through. And then the other thing is that if you would like to pose a question, there is a little question mark on the control panel. So you can click on that question mark and then type in the question. And Justin and Martin are here to answer all questions. And as we always say, the tougher, the better. They like it tough, these two. They like it difficult. Okay, I'm going to switch my camera off and hand over to you, Justin. You are going to take us through the initial part of the presentation.
Great, Alec. Yes. So if you can just move through the slides for me, that would be great. Yeah, thanks everyone for joining us. We'll try and keep it certainly quite interesting and stay off too much of the detail without leaving out the important bits. First, I must just say, Alec, unfortunately, this is the part where we have to disclose we are in fact a financial service provider and authorized FSP in South Africa. But that doesn't mean that in this type of event we're giving any sort of form of advice. We do recommend that you go off and get specific advice before you buy and sell any form of security. And certainly this is here for your benefit. As I say, we do have consultants that are registered that can actually help you through the process of investing. But please, for the moment, we give you a lot of forward-looking numbers, and any past performance does not necessarily guarantee future performance. Thanks for that one, Alec. So I think there are 2 things that I want to say to kick off. First of all, we have an investment committee of well-known South African, actually predominantly experts, and we go through a process of approving specific cities and states. And I think what is new about today's presentation is that we have started to reconsider the way that we look at states. And in fact, there are cities that are very high performance cities within certain states that we wouldn't look at. And today is the perfect example of that. Our investment committee, and the dark gray blocks were the states that we're not in, that they approved for us to invest in. And subsequently, the debate over the last couple of months has been really about, yes, but what about cities that are performing well in those other states? And this one is that we're going to talk about today is in Ohio and the city of Cincinnati. So if you move on, I'll give a little bit of detail of what's happening in Cincinnati. So first of all, it is a fast-growing modern city. And Alec, if you want to move on there, you can help people to get an understanding of Cincinnati. Yeah, so I think first of all, 8 Fortune 500 companies have their headquarters in Cincinnati, which is quite amazing. Certainly not one of the cities you would think of as being a business hub. It's the largest MSA in Ohio. It's the fastest growing economy in the Midwest, which I think is also very interesting. And of course, it's got a really nice population. And I think this is another debatable point. If you've got a medical corridor, and both of these buildings that we're going to talk about today are in this medical corridor, it's important that you have a population that can sustain them. So nice big population of 1.6 million odd workers and 2.1 million in population in total. There are 150 colleges and universities, which is quite phenomenal. So, I think that we don't have to go into a lot more detail, but it's actually a pretty interesting and exciting city, which is why we got the nod from the old boys to move forward and go into these two buildings. So we bought these two buildings, Alec, and I think the second point that I was going to make that I haven't quite covered is that we have got one analyst that sits in our Atlanta office that all he does is go through deals all day that we get through multiple channels off market, and we look at, and it's really hard to find these gems. And you can see both of these buildings, I've included the photos because they really are beautiful buildings, as you can understand. They are really solid brick and mortar, not made of stick and wood, as a lot of buildings are in the US. And I think that you'll see that a lot of the similarities, like these hospitals are both in medical corridors, they both are adjacent to or in very close proximity to massive hospital systems. And of course, there's a huge synergistic relationship between hospitals and these medical office buildings. So this one is in Kenwood Crossing. It's about a 30,000 square foot building. And this one is adjacent to the big Mercy Health Jewish Hospital, which is a 186 bed sort of general hospital. And Kenwood is the highest rental in the state of Ohio in terms of commercial buildings, which is quite interesting, about 33% higher rentals in the Kenwood area than in other parts of Cincinnati. The second one is, and both these buildings, by the way, are on this Redwood corridor, medical corridor, and this is called Red Bank Village. Also, as you can see, a beautiful building. And you'll just notice on the signage here, the sort of tenants. We'll get to the tenants now, but this is the Davidia suite opening there, and Davidia is a national dialysis center. So it gives you an idea of the caliber of tenants.
Redwood. Justin, if I can just jump in there for a second, and just for some of the new listeners online today, we maybe not have covered the usual blurb about who we are and why we actually are in medical, but at a very high level, I think it's important to note we invest into medical real estate because we believe that it's one of the safest, most resilient niches in the United States, certainly for investors from around the world. We've seen that during COVID, healthcare investments performed exceptionally well. And why? Because the tenants there are tenants who are part of your community. They are medical practitioners who stay a long time. They pretty much, once they move in and they are in the buildings, don't move out. And so you've got tenants who are profitable and stay out for a long time. And so they generate consistent dividends and returns to the landlord every single month. And that's the reason why we focus exclusively on these types of medical buildings. And you can see over here, Justin, showing you two magnificent buildings in the right space, in the right location, with the right population growth.
Yeah, thanks. Apologies for that. I mean, we forget, Alec, because we've been on your show so many times. We think that it's the same guest every week. But yeah, for those of you that are new, I think Martin covered that. If we look at these buildings both together, we look at them as a portfolio. We bought them as a portfolio. I think, again, talking to the fundamentals, number one, long leases. These are 4.99, nearly 5-year WALT, which means that the average lease period that's still in the building is nearly 5 years. The other thing is 95% leased. That means that the tenant's already there for 5 years. So we invest for a 5-year period. We acquire the building now. We collect the rent on your behalf. We pay the rent over to you in the form of a dividend. At the end of the 5-year period, we sell the building. We take some capital growth, and then we pay you out a share of the capital growth. So I think if you think 95% leased for 5 years, it's a fantastic core type investment. I think both buildings are A-class, as you've seen from the pictures. In other words, really good high-level, top-end commercial buildings. Total square foot of 67,000 square foot. Why I'm telling you that is that a portfolio of two buildings like that, maybe if you can add one or two, it becomes very attractive when you exit, when you ultimately sell the building in 5 years' time. And I think that the next thing that's really important about these buildings is that they have a fantastic mix of tenants. I mentioned DeVita Kidney Care, but it's also got Fresenius in the other building, which is the other large kidney care provider, and then some other big ones. And we'll get to that a little bit later on. And I think, yeah, we do have a partner in this building, which I think is quite important. This is White Capital, is one of our favorite partners at the moment. And just to give you a bit of history, the average cash on cash that they have paid out in all of our buildings is 8.1%, or over 8.1% actually. It's a minimum of 8.1% cash on cash. And on all of their buildings, the average that we're projecting is 12.4%. This particular building, it's pretty much on the nail. It's 8% cash on cash, paid out quarterly, and then 12% IRR is the number that we are targeting. And as I say, we have become more conservative over time and build in all sorts of little additional buffers in case we hit another COVID. So I think that's that sums up that slide, Alec. Let's move on to the actual rent roll. And I think what's really nice, and for any of you who are new to how we operate, you know, if you invest in a fund or any other type of REIT, you will find that you buy into you know, a large pool of property. You can't really work out, you know, how good it is or how good it isn't. You look at last year's performance, which is no indication of future performance. The beauty here is you can make your own assessment, because you can look at these tenants and you can look at the quality of the tenants. You can decide whether or not this is a worthwhile risk or not. And this is something we are obviously quite obsessive about. In Kenwood, absolutely fantastic symbiotic relationship between all of those tenants. People, patients are bounced around from one particular service provider to the other, which is great. Red Bank property is not 100% medical, but there again, this is one of our value plays. We have a vacant space of 3,500 square foot there, and that is something that we plan to fill within the first 24 months. In fact, we are conservative on that. And of course, we've got a few smaller tenants that we would like to replace with medical tenants when their lease term runs out. So yeah, I think that sums it up. But basically, the important thing here is 5 years, 4.9 WALT, average weighted average lease period.
Justin, I think it's important to also note that, you know, a lot of the healthcare practitioners in America actually sign 10-year leases plus, which really gives you that resilience. When you get to buildings like this, what you'll find is after they've been there a long time, their option periods are often 5 years. So they'll sign another 5 years, another 5 years. But remember, for a medical practitioner to move out and take all their equipment and move to another location, especially when they're well known and they're profitable, it's very unlikely. And so that's the reason why healthcare assets for us are really the right kind of play. We've found over 7 years. Remember, we've been doing this for 7 years. The team has been acquiring assets, offering it to investors around the world. You know, we haven't mentioned also that we've got investors from over 20 countries. South Africa is a huge part of our business, and especially under the current situation, we find more and more South Africans wanting to invest and diversify into these kind of assets.
Alec, we lost you.
No, you haven't lost me. A little user error. I did not put my my microphone was on mute. Apologies. We've got a lot of questions, guys. Can I throw some at you and then continue with the presentation?
That sounds great.
Vanessa asks, what are the tax implications involved, please?
That's a very good question, Vanessa. And I think, Mark, I've already started answering it, so I'll go for it. So I think when you invest into America, there are a number of things you have to take into consideration, especially if you're buying a building or a house or property there. Number one, if you sell the property, you're going to get taxed on your capital gain. Number two, you have withholding taxes. So you have to pay withholding taxes in the US and then claim it back when you repatriate your money to wherever you are. And what we do is we solve all that for you. And we've got a structuring system that basically operates through the Seychelles. And what that means is that Seychelles, there's no tax, no capital gains tax. So basically, we get your money back to the Seychelles. We pay all the taxes in the US. And the amazing thing is that the leakage that we do through our smart structuring is only around about 1%. So you can get this type of investment with an 11% IRR after taxes in the US, which is quite bizarre. Then, if you are, depending on your domicile, if you're in South Africa, you would have to declare that income as a dividend from a foreign source, and your maximum tax payment would then be 20% on that as a foreign capital dividend.
Justin, if I can just jump in and add to that. So just a bit of terminology. In terms of cash on cash, what that means is if a person invests $100,000 and we say you get 8% cash on cash, what that means is you'll get $8,000 projected in the year, $2,000 a quarter. And then the capital gain that you earn after the 5 years, if you add that together with your cash on cash, that is your internal rate of return. It's a metric that says, what have I earned in total per year in US dollars? And that gets you to the double-digit number. And that's where our track record is exemplary. We've produced exits over the past couple of years that are 11% plus to predominantly South African investors.
Martin, there's a question from Brian, and just to remind you, if you'd like to pose a question on the little question mark, you can click on that and write it in. Brian, and oh, by the way, I don't identify your surname, so only use your first name just to keep your anonymity. Brian's question is, on my statement, it's listed as interest. Why do you call earnings dividends, as this can have an effect on the tax to be paid? I think it's a good opportunity to clarify that.
Yeah, that's a great answer. I'll jump in there. So what happens is when we acquire a building, Alec, I forget who the person who answers the question is. When we close, there's a period between closing and listing, and for that period we pay interest because we're unable to pay a dividend because we haven't actually acquired we haven't listed the property yet. Bear in mind, we list these things on an official exchange. So that period is covered by interest, and also on our ODH, our diversified products, and from the period that your money is invested and the money lands in the account of the investment, we pay interest until the listing at the end of the period, and that is normally quite an extended period because we wait for that whole ODH to get filled up. So that might be 3 months or 4 months of interest only. So I hope that is more understandable.
But it's the same thing. So whether it's called interest or dividends, the bottom line is your money's at work, it's earning US dollars, and it's purely a description of either interest or dividend, as Justin explained.
So no impact, Brian, on your tax situation. Terran asks, do you have any evergreen funds where one invests in a specific project indefinitely, i.e. not the 5 years?
No, we don't. We believe very specifically that people should be allowed to invest. You know when you're going in, you know when you're going out. It's very important, especially for new investors, that they want to have finite information. So all our brochures, before you invest, will be very transparent. What we earn, what we make, what you make, what the timing of this investment is. And it's important that we stick to that. Sometimes, obviously, when there's things like COVID, you may have a building that's delayed by a year when we exit, because you never want to exit in the middle of a recession or a bad event. Sometimes, for example, like on Medical 5, we get a great offer and we'll exit a little bit earlier. But we do believe that a finite investment period is important for investors, especially South Africans who never know what their future is going to be or what they're going to need the money for, versus an evergreen fund.
Andrew, Andrew, I did see you were trying to get into our birthday party yesterday, and apologies that you couldn't come through, but the question that Andrew's asking is, why do you hold on for 5 years when the rental income is so good? If recurring income is good, why not hold it for longer periods than 5 years? Which is a follow-up to what you've just said, Martin. But if, and I get what Andrew's saying, if you really are, if it's pumping, can't you just maybe push it out a year or two?
So Andrew, it's a great question. One of my favorite questions. When investors invest at the very beginning, their first question to us is normally, why do I have to wait 5 years? Can't I actually just invest for 3 years? But real estate is typically a long-term play. Think about a building in Johannesburg if you bought, or a house in South Africa. You're not really going to get much growth in the first 2-3 years, especially in America, where you've got consistent fundamentals, where your income is increasing by, call it 2 to 3% per annum over the 5 years. So the typical period in most real estate transactions around the world, when it's not a construction type development, is 5 years. Especially in the United States, it's 5 years. But the real question is, what happens at the end of 5 years? So a lot of our investors turn around and say, it's a great asset, why are you selling? So at that point, it's very much up to the investors. What we believe as OrbVest, it's important that it's not just paper money. Sell it, bank your money, touch it, feel it, it's yours. If you decide to reinvest into a similar asset at that time, that's your choice. So we like people to earn real profit, real money, but it is an important aspect going forward. If investors in a particular asset found it was amazing and decided they don't want to sell, well, that's a separate discussion. Those that do want to exit can still exit.
I think it's a big subject, but I mean, look what it does to your return. If you invest, you get a great, whatever it is, 8% return. But Andrew, if you flip it on and it pushes that up to 11%, and you're able to move into the next one, you're effectively increasing your return from 8 to 11 by doing the rotation every 5 years.
Okay, we've got a lot of questions, so I'm going to just take another 5 and then perhaps get back to the presentation, because I know you've got plenty more to tell us about that, Justin. Devin asks, why did I earn interest on some buildings and not on others before it's listed? I'm not referring to ODH.
I'll take that. So some of the buildings, what happened was, if it's delayed, and we normally say, if you typically sign a LOI, it takes 60 days to close, and it's delayed beyond your control. What we as OrbVest have taken a call in the past to say that's unfair to the investors. We as OrbVest will pay interest for the extended period, not to prejudice the investors. Because it's very important that when someone invests their money, they need to know that their money goes to work within, call it 60, 90 days, and that thereafter they can look forward to dividends over the following 5 years. So yes, so that was a move from the OrbVest executive team.
There are a couple of questions. Sorry, Jason.
No, I'll say, that was, I think it was Medical 29 that we had a significant delay in the closing, and that would answer that question for Devin.
Pete's got 2 questions. Adding to the tax question, with the domicile of the investment in the Seychelles, what needs to be in place from an estate administration and tax point of view?
Yeah, I'm not sure I'm understanding the question 100%, Alec. Maybe what we should do is...
So Justin, I can take this. I think really what you're referring to is, estate planning. And so that's a whole separate subject. We actually had a huge webinar about 2 weeks ago on it to explain to people, but really it goes down to the amount that you're investing. I think anywhere in the world, you need to have a will. And you need to make sure your assets are protected. We are very comfortable that we're able to ensure that our investors anywhere in the world are protected. Your money is protected. And obviously, the larger the amount, the more structures you might need. But I'd like to take that offline with the individual and say that we have various client service relationship managers who can take you through all those various aspects. What we like to do is just get people seamlessly into our platform. Let you dip your toe in the water, spread your money over investments. But before you even do that, ask all the questions. We'll take you through all the various aspects and make sure you're comfortable. I always say, Alec, that the one thing that we've experienced over 7 years is we started off with high net worth individuals. And every one of those individuals around the world always has a very good lawyer and a very good accountant. And so we've certainly had those questions posed over all the years.
And many times. Well, Pete, there we go. You've got a video, I'm sure, of the webinar that was held 2 weeks ago. You'll pick it up on OrbVest, no doubt, or just drop us a mail. You can send it to me and I'll pass it on to Martin, or I think, Martin, what's your email address?
It's martin@orbvest.com and Justin's is justin@orbvest.com. Nice and easy.
Very simple, very simple. And Pete's second question is, can the interest or dividend be reinvested in the chosen investment instead of just lying in the wallet, not earning anything?
Well, it can't go into the original investment, because normally when we do finish it, unless there's some space available, like we might show on West Orange later, it's generally fully subscribed. But what people do with their returns is it goes into their wallet, and they can do three things with it. They can reinvest it into any other project, they can simply leave it there, or they can withdraw it. And so those are the options. Remember, at all times, it's your money, it goes to you, and every single person's situation is unique.
Vanessa has a follow-up to her initial question. So each investor is not listed separately. Is it under a South African investor combined umbrella? And are there then no estate duty implications?
Justin, you're on mute.
Yeah, so no, we don't have a local collection point. You move your money offshore and you make the investment offshore. I would say that 90% of our investors by number invest in their personal name, and obviously the high net worth guys will have some sort of offshore structure for estate planning point of view. I hope I answered that correctly.
And that's something, Alec, I want to jump in. That's very important for everyone to understand. We really do, and I mean this. We have invested from $5,000 in the world right up to multi-million dollars. And so that's what makes OrbVest unique. It doesn't make a difference how much money you've got. Everybody can go in. You don't need fancy structures. You don't need to have the difficulty of investing. That's what we do. We make investing offshore simple. We help you take your money into an offshore entity and get it into the US and earn dividends. And very importantly is that when you actually move your money offshore, it's offshore. It's no longer in South Africa. It goes out via your foreign investment allowance or your single discretionary allowance, and you're now earning dollars offshore.
Last question in this round comes from Mukunde, who says, are you able to reinvest into another property after the 5 years and thus avoid capital gains tax?
So maybe the answer to that, Justin, is that in America, there's a 1031 exchange. And, you know, what a lot of people do is they'll actually just roll their money from one into another. But what we do is certainly you're able to invest into another property. Your capital gain event or your taxable event is something that unfortunately you do have to pay a little bit, but it's not material in the numbers. And most importantly, if you invest via the Seychelles, it's already built into the returns that we are disclosing on the screen. So we've done everything for you. So it's not that you're going to see a 12 and when you get your money, you're going to end up with a 10 or a 9. We've already disclosed the fact that we've built it into all our calculations. You want to jump in on that, Justin?
Yeah, absolutely. I think this is one of the very smart things that we've managed to achieve that makes it simple. We go through this exchange. Admittedly, it's a small exchange in the Seychelles, but it is part of the World Federation of Exchanges. So effectively, you're buying a listed security. So what in effect that means is that when the 5 year, when the dividends are paid out, they're paid out as a dividend. So that means maximum 20% dividends tax from foreign earnings. As a South African, please, I don't know where you're from, so I'm making a guess here. And then, of course, at the end of the period, we return your capital. So it's a return of capital. Of course, that's not a tax event, and your capital gain is paid as a dividend again. So once again, your maximum taxable income in South Africa will be sitting at a maximum of 20%. All the other stuff, as Martin said, we've dealt with in the US by using our Trump type tax laws, if I can put it that way.
Brilliant. Just to remind you, you can still pose questions. We're just going to give Justin an opportunity to complete the presentation before we go to the next round. But please pose your questions, and you do that by having a look at the little question mark, click on that and type it in. You'll be kept anonymous. I won't use your surname. Justin, back to the presentation.
Yeah, great. I think in the interest of time, we'll move up as fast as we can. Let's have a look at the actual tables of income and earnings, and we can spend literally a few seconds on those. So just move forward a slide or two. Yeah, so I think there it is, purchase price of the building 12.8. You will notice that we always provide for all of the expenses that we believe we will get over the next 5 years or 6 years, actually, in some circumstances. And you'll see there's a huge, nearly $500,000 that we provide for tenant installation, leasing commission, for repurposing that vacant space and any other space that comes available. All the costs are built in up front, so everything that we anticipate that it will cost and more is built in, and that takes the total sort of project cost to 14 million. And all of our analysis is done based on that 14.6 million. The next thing that's very important, Alec, is, as you know, you can cheat by taking out a bigger bond. Certainly those buy-to-let investors online will attest to that. We are very strict on loan to value. In other words, we only allow ourselves to take a loan of a certain proportion. Here you can see it's 56% of the value of the property. And then the big one is a thing called debt coverage ratio. And all that means is that the income or the net income from the property can pay the debt or service the debt 2.3 times per year. So you've got a huge cushion there. Any crazy COVID Mark III happens in the US, you know, you don't have the risk of losing your capital, and that's really what our first principle is protection of capital. Yeah, again, $3.8 million available in this portfolio of two. Probably one is will go on launch immediately, so it leaves about 2 million in equity available.
So just my point on that also, Alec, is that you'll see there where it shows the 14 million, which is 8 million of debt and 6 million of equity. The 6 million of equity, we normally reserve what's known as a corporate investor. That corporate investor, just so you understand, may be a large player out of Brazil or out of America that'll come in and invest a couple of $1 million into the same deal. So, you know, that's the beauty of our investments. You get from the largest guys to a small person who just wants to invest $5,000, all going into the same investment, all earning more or less the exact same returns. And so we treat everyone in a very similar manner.
I'm going to throw a bit in the last bit on this slide here, Alec, because I know that we always get questions. Well, where do you guys make money? You know, we've heard that you know, it's always the investment managers that make the money. Well, the beauty of our model is that we are aligned only once we have performed. So we have a thing called an above hurdle. That's that thing you see, hurdle rate called 7%. So only after we paid you a 7% dividend do we start earning money on the actual income during the course of the project. And at the end, we take a larger chunk of the winnings at the end, in other words, the capital gain. So we've got to make sure, number one, we run that building absolutely efficiently, and number two, we add value to the building so that when we sell it after 5 years, we can get paid. So, you know, I think that's very important. There are some other fees involved, but most of that stuff is money that actually goes out to service providers, etc. But I think that's a super important point, Alec, if we can move on to the big one, which is obviously returns. Mark, you always love this slide. Why don't you talk to it?
So thanks, Justin. So what you can see really over here is an illustration of the returns, which shows that if somebody had to invest money and it's just notional example amounts, you know, what you would earn more or less per year, averaging about 8%. And then obviously in year 5, what happens is you get your capital growth and your exit and your profit from the building. And we often get asked the question, how do you generate that capital growth or profit? And it's because, remember, there is inflation and escalation in the United States. Every single lease has in it between 2 and 3% escalation, which means if you take a static building and your income increases every single year and you sell it on a similar principle after 5 years because you've got more income, your building is worth more money. And that's what happens. You generate a capital gain, and you can see the returns over there. What's important to note also is there are 2 categories. One is generally what we'll show to our international and US investors. And then obviously the table below there, you'll see there's a pre-tax and an after-tax amount. And that is where we've taken into account the taxation at the individual building level. And so that's what you would expect as a South African, as a minimum, to hopefully earn 11% plus on this investment. Right, so Alec, I was just going to say that before we get to the next exciting launch, which is a huge milestone for OrbVest, and we'll talk about it in the next minute or two, is that we do have our Medical 33 asset, which is West Orange. We are approaching the close in the next literally 2 weeks, and we're very excited about this. It's in Orlando, Florida. As I mentioned last time, I've personally been there. It's a fantastic 2-building portfolio. It is filled with medical practitioners throughout. It's right opposite the hospital campus and the new cancer center, and really this is a fantastic investment. And so there's a little bit of space left in this, because people often say, if I come and I want to diversify, I don't want to put my money into one, and we advise you not to. We would say spread it over a couple of investments. So we always keep a little bit aside for new investors who can then come in and go into Medical 34 Cincinnati, into this, and also into our other products. And so we're just going to fly through this very quickly. In the interest of time, I want to get to the triple net portfolio. You can see pictures of the buildings, and if we keep going, Alec, fantastic building over here, very well kitted out inside. And on the bottom left hand side, you'll see the hospital in the background right across the road. So they get enormous referrals from the hospital into this building right in Orlando, Florida, which is really a massively high growth state and area at the moment, which is really diversifying from what used to be known as predominantly Disney World and Universal. It certainly is not that anymore. Now, Alec, onto triple net. So this really is a big moment for OrbVest. Over the past 7 years, what we've come to understand from people is what they really want. They are seeking to earn US dollars with very low risk. And so what we did was, about 18 months ago, we launched what's known as ODH, OrbVest Diversified Holdings. And what that was it was a product that allowed a person who didn't want to actually go into individual buildings and figure out, what does each building mean? I don't have the time for it. I don't understand it. And also the larger players said, I'm not going to give you $1 million into each building. I'll give you $5 million. You diversify the money on my behalf. And so that, as you know, we launched 1, then 2, 3, 4. They've all been oversubscribed and sold out. At the same time, what happened was, we were looking at triple net buildings in America. And it's taken a lot of time to get this approved through all our channels. A triple net lease, to start off, is where you have a tenant who pays for almost every single thing. And I mean everything. They pay all the expenses. They are a tenant that is generally a single tenant building. And what happens is that these tenants have signed very long leases. So in these single tenant triple net lease buildings, the only thing a landlord may have to do is worry about potentially the roof and the parking and maybe 1 or 2 other minor things. So it's very easy to predict the income. It is an enormous, enormous market in America. To give you an idea, that the 2 well-known brands that everyone should know of, which is CVS and Walgreens, which the equivalent in South Africa might be Clicks or Dis-Chem, sign anywhere from 10 to 20-year leases. They are numbering approximately 10,000 outlets each. So you can understand that there is certainly enough of them around. And so we as OrbVest have been planning for a while, how do we get 8 or 10 of these buildings together in a portfolio that are in a position to generate for investors from around the world the ability to earn 7 to 8% cash on cash dividends and double-digit returns, knowing that there are 10 plus years in the leases, the weighted average lease term, and that these buildings have tenants that generally are very, very, very strong. Many of them are actually NASDAQ listed tenants. They have corporate guarantees. And so with the launch of our triple net portfolio, we're going to start with an initial portfolio of give or take $30 to $50 million. We will raise about $12 million equity. The $12 million equity will be raised from around the world, and we will then acquire 8 of these assets. As you can see, it is going to be a mixture and a portfolio of a CVS, a Walgreens, a dental practice, a DaVita, which is obviously listed on the NASDAQ. It is an imaging center and various other healthcare practitioners. And when you put these together, you get an ecosystem of tenants and buildings that are very resilient, and we will then hold them for the same 5-year period, and we will sell them with still a very long lease in hand. And we believe that we will obviously get the interest of the large players who will snap up this portfolio. Because when you put together all these buildings into a nice ecosystem, it attracts the interest of the big players because we've done all the hard work for them. And so that's the reason why we're very excited about this launch today. And I think that just as ODH was a resounding success, we've already tested it with our partners around the world and also in America. And there is enormous interest given the fact that you are getting the returns, but even lower risk. And that's the launch of our triple net portfolio today.
And it's definitely only in the medical field, still focused in that area. Only
Healthcare practitioners and a healthcare portfolio, which again makes it very unique around the world, where people saying there's such a breath of fresh air. And ultimately, what it does is it gives that consistency. Because remember, when we bought the 8 or 10, it's going to be specific buildings, and it's very easy for us to raise the money and to buy them. And then when it's fully subscribed, we will then go and buy another 8 or 10, depending on the success of the first triple net one.
Martin, I see at the bottom the holding period here is 5.5 years. So that's a little longer than the other OrbVest projects.
The only reason why we say 5.5 is because during the first couple of months, whilst you're raising the money and whilst you're acquiring the assets, that may be 6 months. But, you know, give or take 5 years, at the right time, we will still exit. You know, I am very comfortable that I think that when we've assembled a great portfolio like this, and in fact, I think that was Andrew that posed the question very early on in the webinar, is that what happens at the end of 5 years? Well, as long as we've got a similar portfolio that we're able to do it to again, you know, I'm sure a lot of people at that time will say, why don't you want to sell? I've been getting great dividends and it's very low risk for the last 5 years. But again, I like people to bank their profit.
Okay, well, we've got a number of questions again. If I can pick up the first of these from Devin. He says, to follow on my initial question, will interest be paid on all new buildings going forward?
I think, Mart, I'll jump in here. I think it's very important to understand that there were some circumstances, as we picked up a little bit earlier on, I think, Devin, from your earlier call, where we paid interest because there was a delay in actually acquiring the building. And so don't confuse that between interest that we pay between the closing and the listing. So I think the answer to that is yes, closing to listing, we will pay interest because we effectively already have the benefit of the asset. So we're earning the money already. And then there are special circumstances that, for example, we have encouraged people to make the investment, and then the 60-day period expires and the building hasn't been acquired yet. And in that case, in circumstances that we feel that you know, that we should pay interest, we will do.
Justin, to answer it also from a different perspective, if you look at an ODH product whereby we're raising $5 million and we're deploying it into different projects, from the time that we get it, you're earning a return on your money straight away. If you look at a triple net portfolio, the same principle will apply. You will start earning money straight away. If you look at a building where, as Justin said, we're buying it and we're closing in 60 days, no. That is a normal hold period. We raise all the money, we then close it like West Orange, and then you start earning.
Lorraine's question is, what is the cost to have a Seychelles trading account?
Just to be very clear there, we set up the trading account effectively is on the exchange, so it's with the merge exchange. It is protected, and actually it costs you nothing unless you go dormant for a long period of time. And even that, you know, I don't think they have they've applied any fees there. So the answer to the question is it costs you nothing as long as you are making investments through the exchange.
Pete's question, he says, I'm invested in your ODH1 with returns of 8% and an IRR of 11%. Why is there a reduction of returns in this investment?
So I think that what you've seen over the past 18 months is the performance of healthcare is certainly creating an environment where it's becoming more and more competitive. What that will do over time is it will drive down the returns slightly. Our view around the world is that anything between a 7 and 8 is great for all investors, even in America, and double-digit returns in total. So some might be 8, some might be 7, but remember, it's all about the risk factor. So, you know, if you take, for example, a medical office building, which is a single building like you saw in Cincinnati, that may average 8%. This particular investment, triple net, may be 7.5%. But again, it's a spread. So just like you would invest in equities, where some do a little bit better than others, I would say to any of our investors, even if they came tomorrow and said, I got $100,000, I'd say, great, put $20,000 into 5 different projects, so you average. And so if you take a ODH where you're very fortunate, you're into like 8 different buildings, and you take a triple net when you're into another 8 or 10, it means you essentially are in 18 buildings in America spread across different states, different tenants.
I'm gonna throw in another answer to that question. I think that we've got to understand that when we started in this business in the early days of Henny 7 years ago, it wasn't even a category, a subcategory, medical office. And so it wasn't a focus, whereas now, after the pandemic, there's a huge amount of capital looking for these type of buildings, the same buildings that we're trying to look for. So the price has increased, and that actually comes down to a thing called cap rate. And I mean, we used to not even look at properties that were below a 7% cap rate. And now, we saw the other day, Martin, that building in Los Angeles, I think it was, that went for a 3% cap rate. I mean, you can explain how long it takes you to get your money back if you invest at a 3% cap rate. So basically, you're paying a little more for the buildings now, I think is the important thing to understand.
So the other thing is, remember, it's always risk versus return. So when you talk about the triple net portfolio, we are getting buildings that have a lease in place that is on average 10 years or more. Now that is so low risk. I mean, if you take a Walgreens or a NASDAQ that does absolute hundreds of billions of dollars and makes enormous profits in America, I mean, those kind of buildings with a corporate guarantee in place, it's as safe as it could almost wish to be. And so there's a lot of demand for those buildings. They are priced at a more aggressive level, but I still believe that we've managed to put together a product that I think is completely acceptable. And I think I'll go forward and make a statement that I think around the world, it's going to probably be a lot more successful than even potentially an ODH, given its returns and its low risk nature.
Vanessa says, what about renovation costs? Surely after 5 years, most buildings need or have had a lot of repairs.
So that's the great thing about a commercial tenant. So remember, in America, for example, you know, when you sign a triple net lease, every single thing inside the building is 100% for the cost of the tenant. So these tenants, whether it's an Aspen dental practice, that's also one of the large players, or any one of these that you see like a DaVita, which is listed on the NASDAQ, you know, all the costs inside are for them. Sometimes you can even go to an absolute triple net, which means every single thing contained on that property is 100% for the actual tenant. That means everything, the roof, the HVAC, the parking, the landscaping, everything. We ourselves try and find a balance where we go for the buildings that have limited exposure. So if there's a roof, we'll make sure there's a warranty in place for 10, 15 years. If there is an acquisition of a particular asset, we'll make sure it's just recently been painted. So there's nothing that is materially going to occur during a holding period. If we investigate the building and we see that there are certain aspects in our reports that require some kind of maintenance in the couple of years ahead, naturally, when we acquire it, we put money aside, which is what you saw in Cincinnati. It's called TR, which is tenant installation or maintenance or CapEx. So we do provide for that in buildings, certainly where it's required.
I have to chip in here again.
Justin?
Alec, you know, we spend a lot of money on a property assessment report, and for Medical 33, for example, and I've actually just flipped to it now for interest to have a look at how many pages. I think it's 147 pages of property report. It gives you an indication of what you'll have to replace and spend, Vanessa, over the next 12 years on the building. It is absolutely mind-blowing how much detail they look at every fire extinguisher, look at the date of expiry. I mean, if you show it to any South African property player, you know, they'll be completely blown away. It's just it's unheard of, the amount of detail that's in those assessments.
It's the difference between doing business in America and pretty much everywhere else in the world. In America, it's a science, and it really is a science. You go into great detail, as those of us who've been engaged there do know. GH's question, he's got two. The first one is, I understand that the triple net project properties have not yet been secured. What's the time frame, and where will they be? What locations?
So in fact, we've launched it now officially today. We already have the first two that we are looking to acquire. And from the time that we launch, we're now going to hit the green light with all our partners. They already know we've been in discussions with them for certainly the past 2-3 months. And in fact, they've actually been quite eager. But even just the launch of a product for OrbVest takes a heck of a long time. We've got to go to the merge exchange. We've got to get it approved by the listing authorities. We've got to get all our compliance in place. And now that it's ready to go, to answer your question directly, I think that from an acquisition perspective, it'll be snapped up very, very quickly. We know what we're going after, and we know that they're available. From an equity perspective, it also takes quite a bit of time to get the wheels going, because, for example, when Justin deals with China, Brazil, or other countries around the world, he now has to do the presentation to them in the next couple of days. They have to convert our brochure into their language and then do a presentation to their clients. But just the same as ODH, it gets going very quickly and it gathers a momentum of its own. I think within 3-4 months, this is completely snapped up and done and closed.
And the location?
Yeah, sorry.
So in terms of location, it'll be in the typical states that we normally go to. We're very cognizant of the fact that certain states perform better than others. But remember, when you are specifically looking at these assets, you are ultimately looking at a fantastic asset that is low risk, that has a 15-year potentially lease to even 20 years with a potentially corporate guarantee behind it in a town that we believe is either growing, has the right fundamentals in place. And again, it needs to be approved by myself, my executive team, and also Henny, who's part of the investment committee and who's the chairman.
Sorry, Justin, did you want to chip in?
No, I just wanted to clarify, Mark, you sounded a bit vague with those properties. I mean, those two properties you're talking about, you've already put in a few LOIs, and I think there's two that are running at the moment. And just to bear in mind that we actually had already acquired the first building, the Great Expressions building, but we decided to take that out and put it into another portfolio. So we actually already own that building. We acquired it at the end of last year.
Perfect, Justin.
Brilliant. And we've got 2 minutes to do 2 questions. The second one, the follow-up from GH, who says, given the increased competition in medical buildings, are there other specialized property niches that you might consider?
I think at this point, we are still comfortable that we can find enough medical office buildings that will generate our required returns going forward. You know, the nice thing about medical is even as competition increases, you know, we don't generally bid online for these buildings. What we like to do is acquire them off market. What's happening is as our brand is growing, so our network is growing, and we're still finding these off market gems like in Cincinnati. We got another 1 or 2 that are coming soon, Alec. I'm not going to disclose those until we've actually signed them. I'm comfortable at the moment that we can generate returns, but I will say to listeners online today that I do think it's going to become more competitive, and I don't see returns increasing over the short term. I in fact see them at the same levels or marginally lower.
One of the dangers of being first to market is that, well, you do get the best to begin with, but finally, this is a question from John, who says, please would you explain cap rate?
Perfect. So a cap rate is in essence the number or the percentage that you use to buy a building. So let's assume you found an old building in an area that had 50% vacancy. That building may trade at an 8 cap rate. What that means is you take your operating income, let's assume it's $500,000, and you divide it by a percentage of 8%, and that will give you your purchase price. What that means is it's an inverse relationship. When the cap rates start to gravitate downwards, meaning towards 7 and towards 6, it's becoming more and more competitive and more expensive. So when we say we were buying buildings at a cap rate of, call it 7 to 8%, it's gravitating down towards the 6% now. When Justin says you are buying a building at a 3% cap rate, if you think about it, if you invested $100 million, you would only end up with at 3%, $3 million income, which is insane. It means you would almost need 33 years to get your money back. So, I mean, that's assuming without gearing and other kind of stuff. So what it means is if you look at the medical industry and the medical niche, there's definitely been a trend downward of cap rates, which means they're becoming more and more expensive, but it's marginal compared to other areas where potentially it's been either more aggressive or, for example, in malls where it's gone from a 7, 8 up to a 9 or 10, meaning there's less demand for shopping malls.
Well, the time has just flown, as it always does, when we're talking about fascinating issues like this and stuff that you're so passionate about. Last word, Justin, from your side, and then you too, Martin, before we close off.
Yeah, Alec, it's so difficult to get so much information through in such a short slot, but we do really appreciate these, these little bits of exposure. I think the important thing is we just need to, what's the easiest way for people to get hold of us if they want more information? We have got a team of people across the country, qualified consultants that can help you with any information. The one thing is to go onto the website, click on the little yellow thing. The other thing, of course, is to go onto the BizNews site and find a little banner somewhere and click on the banner and give us your details, and we'll contact you. Alec, well, I suppose last but not least, they can email you or Stuart.
Yeah, and I think it's probably better with Stuart. We know he's the efficient one in our team. The PDF that we produced on the unrest here in South Africa has also got a link through to OrbVest as well. So you can click on that and that'll give you all the information you need. But there on the screen, you can see the website. So easy to remember. And Martin and Justin are easy names to remember with at orbvest.com. So pretty simple. Martin, for your closing words.
So thank you, Alec, again for hosting this. It really is such a privilege to be able to help people in South Africa and around the world to get into investments offshore and to generate the dividends and returns that they are hoping for. And so I just want to end off by saying, Justin and myself were exactly like every one of you listening online. We come from South Africa. We wanted to earn money offshore. We didn't believe it was possible. It was too difficult. And it's such an honor to be able to be in the position to help other South Africans now. And so again, it's easy to get into it. It's a lot easier than you actually think. You just go and register online. You don't even have to invest. Just try it, get the information, see how it goes. But you will find, like most other people that we've come across, that over time you get comfortable, you'll see the investments, and then spread your risk, diversify. And what we've shown you today is two other opportunities to just build a mini portfolio overseas that again creates that diversification. And so we look forward to seeing how these things proceed going forward. Alec, thank you again for your time.
Always a pleasure. Nice to be talking to someone in New York with the sun rising over there while we're getting out of winter slowly. Of course, Justin doesn't know what winter is living in Durban. But up here on the Halfveld, it is getting a little better, and always great talking with you guys. And we at the conference, it's not even a month now, Martin. You're going to be telling us your story. I'm really looking forward to that.
Alec, certainly. You know what? I haven't been back to South Africa for going on now 1.5 years. And so I really am looking forward to being back in South Africa and seeing friends and family and familiar faces. And more importantly, I know that it's such a huge event for BizNews And certainly as you build up to it, I wish you all the very best. I know that it's a very big thing for you and your community, and they're going to get huge value out of it.
Indeed. Well, look forward to seeing you there. One of the most beautiful parts of South Africa, but you know that coming from Durban, of course. If we need it, if people need a little de-stressing, there's fewer better places than going into the Berg. Wonderful. Nice to see you guys. And this will obviously be online, the recording, in just a little while. And until the next time, from the team here at BizNews and, of course, our business partners at OrbVest, cheerio.
Bye.